All right, let's break down one of the most common and most complicated parts of our financial lives, the credit card.
And let's just start with a number, a huge one, $1 trillion. That's how much credit card debt Americans are carrying right now. And a number that big, well, it brings up a really important question.
So, which is it? Is that trillion-dollar debt just an unfortunate accident of modern life? Or is it actually the intended result of a very, very carefully designed system? That's what we're going to dig into today, the machine that's humming away behind your monthly statement. To get to the bottom of that trillion-dollar question, we've got to start with the person holding the card in their hand. We have to start with us. But before we jump straight to pointing fingers at the banks, we need to understand the psychology they're tapping into. Because it turns out, our relationship with debt isn't just about math, it's about how our brains work. You know, when researchers try to figure out why people fall into debt, it's never just one simple thing. It's more like a perfect storm, right? You've got our own psychology, our personal financial situation, and then, of course, the specific ways the credit card industry operates. They all feed into each other.
So let's break that down. Studies point to a bunch of psychological drivers that can lead to debt. And while all of these play a role, research shows two of them have a particularly powerful link to carrying a balance: our tendency to buy on impulse and our level of self-esteem.
And that first one brings us to something called impulsive buying theory. The basic idea? A lot of the time, we don't think through our purchases logically. We just react. We see a good deal, we feel a certain way, and we buy. And credit cards? They're like the ultimate enabler, because they take away that immediate sting of watching cash leave your wallet. And the other big factor is self-esteem. It turns out there's a real, documented link between feeling down about yourself and spending money. For some people, that act of buying something new delivers a little hit of satisfaction, a temporary boost that feels really good, but can end up being really, really expensive. So you've got these two powerful human triggers, impulse and self-esteem. And they don't just exist in a vacuum. No, they fit perfectly into the business model we're talking about. Which brings us to a really interesting question. Who exactly is the bank's ideal customer? So let's get right back to that first question we asked. Do card companies want you in debt? The short answer is, yeah, absolutely. See, inside the industry, they basically have two names for their customers. You have revolvers, the people who carry a balance month to month. They're the main profit engine. And then you have the deadbeats.
And yeah, you heard that right. This quote from an industry insider says it all. If you're one of those people who pays your bill in full every single month so you're not generating any interest for the bank, well, in their lingo, you're a deadbeat. It's a pretty blunt term, right? But it tells you everything you need to know about their business model.
So how do they keep people in that profitable revolver category? Well, one of their most effective tools is the minimum payment. Honestly, it's a work of genius from a psychological standpoint. They offer you this tiny, manageable number so it feels easy to just pay that and not worry. But meanwhile, the huge remaining balance is quietly getting hit with massive interest charges day after day. And the results of falling into that trap are just mind-blowing. Let's take a pretty standard example. $5,000 on a card with 20% interest. If you only make the minimum payments, it could take you over 55 years to pay it off. And in the end, you'd have paid more than $22,000 just in interest. That's over 4 times what you originally spent. So this begs a really critical question. If their revolvers are paying all this extra money in interest, where's all that cash going? Well, here's the twist. A huge chunk of it is actually being used to pay for all those fancy rewards programs, the points, and the cash back that so many of us chase after. Yeah, a really fascinating study from the Federal Reserve actually put numbers to this. It turns out that if you have a high credit score, you on average actually make about $7 a month from your rewards cards. But if your credit score is lower, you end up losing almost $5 a month, mostly because of interest payments.
And when you zoom out and look at the whole country, what does that add up to? It's a transfer of over $15 billion every single year, from the pockets of one group of consumers paying interest and fees to fund the rewards and benefits of another group.
So what do you call a system that works like that? Well, legal scholars don't mince words. They call it exactly what it looks like: a massive, structural redistribution of wealth, moving money from less well-off households to more affluent ones, and, of course, to the banks. And as you might guess, this burden is not shared equally. The data is pretty clear. households of color are significantly more likely to carry credit card debt. And what that means is they end up disproportionately funding this multi-billion-dollar reward system through the interest they pay.
So the big question is, how on earth did we get a system like this? And maybe more importantly, can the rules of the game ever be changed?
Well, for a quick history lesson, the credit card world as we know it was really created by a couple of key Supreme Court cases. In a nutshell, they allowed banks to set up shop in states with really loose rules on interest rates, like South Dakota or Delaware, and then export those high rates to customers all over the country. This went on until 2009, when a big piece of legislation called the Card Act came in and tried to create some reforms.
But here's the thing, it wasn't a silver bullet. The industry is incredibly good at adapting. So while the law bans some of the worst practices, banks just invented a whole new menu of fees to make up for it. And when researchers looked at the numbers, the total cost for the average consumer hadn't really budged at all.
And that brings us right up to today. With average interest rates hitting all-time highs, there is a serious conversation happening now. And what's really interesting is that it's coming from both sides of the aisle. People are asking if it's finally time for the government to step in and put a national cap on how much interest credit card companies can charge.
So, the next time you open your credit card statement, this is the question to think about. After seeing the psychology, the business model, the history of it all, is that balance you see just a series of personal choices, or is it the predictable result of a much larger and far more profitable design?